And, it's good to say that while the moves may not be very big, barring just the few names that I mentioned, on the laggards list, the cuts are not deeper either. So, the biggest loser today, for instance, is UPL, which is less than 0.5% lower. Hindalco, Eicher, Britannia, just very marginal dots of red really emerging there. And so can be said about a Maruti as well. So that really is a comforting sign. But let's welcome on board Sundeep Sikka as well and get in his take on where the markets are headed. Sandeep, hi, morning. We were just counting. It's a 37% rally that the Nifty alone has seen from the March lows. What explains this, Sandeep? Is it this consensus and the pessimism all around? Is it the fear of missing out feeling that every dip is getting bought into? What is it?
Aisha, thanks for having me on the show. I think the way you have to see this is, and I think markets typically overreact. Whenever we see, I think we saw when the correction, when it happened in March, I think we saw Nifty coming down from 12,000 to almost 7,500. And for sure, as the economy is opening up, and I think a lot of businesses, some businesses have for sure been impacted by the COVID. There's going to be slowdown because of the lockdown. But I think overall, I think people are realizing things may not be as bad as, it was. A lot of, the household saving we have been seeing, which used to come in SIPs. The same SIPs continue. We have not seen investors terminate their SIPs. I think that's also a sign of maturity of these investors over the years. Because earlier we used to see whenever there was a correction, a deep correction, investors used to stop their SIPs. But that's really changed this time. So I think it's a mix of multiple things. And I think one is also realizing the economy, for sure, whether 1 or 2 quarters are gone, but things may not be as bad as they appeared 2 months back.
Sure. The other thing, Sandeep, in the market, while we may be fascinated with the Nifty number, is that some of these penny stocks as well have held up a fair lot. That's looking a little unsettling, if I can use that word, that it's the quality of names going up, which is a little discomforting. That aside, what's the message that you are handing out right now? Stick with quality, or is there a better chance of the broader market actually leading recovery and bigger money to be made when it comes to the small and mid caps?
As an asset management company, I think we prefer sticking with the quality. I think we believe it's important to stick with the bigger names, the quality. I think the balance sheet is more important than the P&L at this point of time. So overall, I think if you see our portfolios are getting more aligned to quality. We have seen a lot of changes within the largest segment where we had invested was financial services. Within financial services also, I think we are going for high quality names. So, but to your question, I think we would like to stay away. I advise investors who are directly investing also to stay away from penny stocks. I think the quality and the balance sheet is more important at this point of time.
Fair point. Also, wanted to understand what is the contribution of retail in total AUMs that you're currently seeing? And are you seeing increased traction from other segments and areas as well by any chance?
It's very interesting. During this lockdown, I think it's been almost 100 days of lockdown. I think we continue seeing new investors coming in. For us as Nippon India Mutual Fund, I think we've been primarily a retail asset management company. 24% of our total AUM comes from retail against an industry average of 17%. What's very interesting trend we have seen during this period is, in spite of the fact almost 100 days of lockdown, all offices closed, still we keep seeing 700 to 800 new investors coming in every day. But what the interesting trend that we have seen is, which is even more different from past, is the new ETF investors. We are roughly adding about 700 to 800 new ETF investors, which is coming in, which is again a sign of times to come. Both the maturity of investors as well as, I think, so the new investors are coming both in SIPs. Every 20 seconds, we are doing a new SIP online. But ETF investors who are coming directly is also showing, the investors are totally, it's a very different mindset of investors, unlike in past who used to shy away from markets whenever there was turbulence.
Okay, let's talk about the contribution of retail as well. Are you seeing increased traction there? Going forward, as well, what will you be looking at in terms of the overall mix, where perhaps you see more growth as well. Talk to us a little bit about the plans there.
The way you need to see, I think our business is divided into 4 parts. One is the first is the mutual fund, which is basically the major contributor at this point of time. Second is ETF. Third is offshore. And the fourth is alternatives. I think the way we are seeing the trend, I think clearly for the mutual fund business, retail continues to grow, and that will remain a focus area. As I mentioned earlier, I think we are adding, even the industry has been adding during this period, new investors during this lockdown. But for us, the fact that I think today we are adding roughly about 600 to 700 new investors every day, and both in mutual fund as well as in ETF, clearly shows, I think, a lot of digital infrastructure that we have created over the years is showing results. Along with that, we are also seeing during this period, institutional investors and the savvy investors, the HNIs, playing a very active role in ETFs, which we have never seen in past. Again, that is another segment that we believe, I think, is going to be very important for our growth in times to come. As far as the offshore allocations are concerned, I think which we manage on behalf of Nippon Life, our parent, and also some of their associates and subsidiaries, there has been a little wait and watch. I think new allocations have not been coming from outside India. But the fourth vertical for us is the private equity. We recently launched a private equity fund, Indo-Japan Startup Fund. We have seen very good marquee investors coming into that fund. I think we have seen Mizo Bank, Development Bank of Japan, Toshiba, Nippon Life, Suzuki who are investing, and the interest in that segment continues to grow. So overall, from our perspective, I think we clearly believe these are the 4 big drivers for the company for future growth. But retail and mutual fund will remain and continue to remain one of the most dominant ones.
Okay, great. So is there also a case of management fee margin compression going forward? What's your outlook there? And with the in terms of the change in management as well, do you aim to look at repositioning the company in order to, win back market share? Would there be anything that you're looking at from that point of view?
Clearly, if you were to look at it, I think the management fee, clearly asset management industry is a volume game. There can always be a case for a few basis points here or there for the compression, which can happen, cannot be ruled out. It has happened across the world. But again, the key lies in how much are we able to increase the volumes. To just give you a perspective, our overall realization over the last 10 years has come down by about 10 basis points, but the profits have gone up 10x because the volumes and the AUMs have increased. So clearly, from our perspective, we see while there will be not major compression in management fee, but the 2 things which remain very critical for us are going to be A, is going to be how to increase volume, and the B is also how do you keep working on operating leverage. We have seen our overall expense structure come down by about 200 crores in the last 2 years, and I think so effectively the key will lie to A, increase volumes, B, to keep the expense structure low, and C will be also to diversify into other revenue streams beyond mutual fund, which we have already started doing.
Sundeep, hi there, good morning. Will you focus on profitability-led growth? Can you share with us the growth outlook for FY21, what's been planned or penciled in?
I think I will not be able to give future guidance, but again, from our perspective, if you were to look at it, like I mentioned earlier, the asset management business is a volume game. The expense structure does not increase in line with the growth in business. But to your earlier question, for us, between top line and bottom line, as a company, our focus will remain on bottom line. And again, in number 2, for us, it will also be to de-risk the business from pure mutual fund into other parts of asset management. Number 3, I think from our perspective, we have also seen over the last 2 years, we saw some headwinds. We lost a lot of market share. The trend has been very positive. I think post the shareholding change, we have seen a lot of institutional investors and HNI investors who had stopped investing come back. And so from our perspective, the revenue growth and the profitability growth will come from 2 sides. A is going to be regaining what we lost. B is going to be overall growth of the market. And I think as we are seeing in other industries, we clearly believe the kind of, as the savings go up, and as with this coronavirus, overall, there will be a trend towards higher savings, and the savings will eventually come into whether it's to do with asset management company, insurance companies. So I think clearly we see the outlook remains positive for us.
Okay, fair enough. And finally, direct channels constitute nearly 50% of the overall distribution mix. So how do you see this changing in a post-COVID world?
Just to correct this, 50% this includes all institutional investors, corporate treasuries also. But if you were to look at only pure direct, which is coming from individual investors, is about 14%. However, having said that, as markets mature, we will clearly see two things happening. You will see matured investors, some of them going to direct, some of them going to ETFs. But in a country where only 2% of the population is investing in capital markets and mutual funds, the base of the pyramid will keep coming through distributors. So from our perspective, we are trying to have a multi-pronged strategy. On one side, we have the investors who are savvy, want to create the portfolio themselves. For them, ETFs and direct channels are available. Also, investors who are at the base of the pyramid, who will always need guidance of advisors. For them, the regular plans are available. But I think one big thing that I've seen, over the period of when we look at all these data of investors, I think we have clearly seen investors who've been guided by advisors. I think they have made far better returns, because many times a lot of direct investors have end up taking a knee-jerk reaction whenever the markets become volatile.
Your time. Thank you so much for joining us and sharing with us the outlook on the AMC business, how things are shaping up for you, and generally dealing as well with the lockdown and the post-COVID world. That's the view coming in from Sundeep Sikka of Nippon Life. A quick glance at the markets and absolutely no abating the up move. Now staring at 10,535, a 350-point bump up for the Sensex. You've got the broader markets pretty much in tandem with the frontliners, and across the board gains helping tilt the advanced decline in favor of the gaining side. Let's take a quick break. Be back with more.